In this video, we're going to take a look at some high-yielding dividend stocks that are currently at risk of seeing a dividend cut. In all these cases, these companies are posting results that have been worsening over the past year, and their dividend payouts are now close to or exceeding 100%. This means they aren't earning enough from their operations, or they're close to not earning enough from their operations to afford their dividend. But as a disclaimer, this doesn't guarantee that any of these stocks will experience a cut. They could miraculously do better in their next quarter, or they could rely on the cash in their balance sheet to sustain their dividend for the time being. But at the very least, every company that we're going to take a look at, I personally wouldn't consider investing in them until they start reporting better numbers. The first stock we'll take a look at today is Horizon Technology Finance, ticker HRZN. This is a business development company that specializes in lending and investing in businesses that are in their development stage. They specifically focus on providing debt investments to companies that operate within the technology, science, and sustainability sectors. So this puts them in the same category as BDCs like Trinity Capital, Hercules Capital, and Triple Point Venture Growth. They've been around since 2004, but they didn't go public until 2010. Today they're one of the smaller BDCs that exist, currently ranking 31st among companies in this sector by market cap. This is a common holding among my viewers because it offers a couple of really attractive features. It currently offers a massive dividend yield that exceeds 15%, and it pays monthly dividends. Obviously, monthly payers are going to be more appealing than quarterly paying stocks because it's easier to budget lifestyle expenses. In December of 2022, they even raised their monthly dividend by 10%, the first time they've increased it since 2011. But despite that recent increase, this company has been reporting worsening financial results for the past few quarters, and their dividend payout ratio is becoming a lot more stressed. In their most recent quarterly results, Horizon Technology reported that they didn't earn enough from their investments to cover their current dividend in Q4 of last year. It says, fourth quarter 2024 net investment income per share of 27 cents, net investment income covers regular monthly distributions for year. Although this statement is true, it gives the wrong impression. Based on this statement, you'd be led to believe that everything is good in terms of their dividend coverage. In 2024, HRZN paid $1.32 in dividends and earned $1.36 in net investment income. That sounds sufficient, but earlier in the year, they did pay a special dividend of 5 cents, which isn't considered part of their regular monthly distributions. Back when they paid that special dividend in early 2024, this company was reporting much better financial results, but after they paid that special dividend, their investment income went downhill for the remainder of the year. They earned 38 cents per share in Q1, 36 cents per share in Q2, and 32 cents in Q3, and then there was a massive dive in Q4 with 27 cents per share for that quarter. This gives them a current dividend payout ratio of 122%, so they're paying a lot more in dividends than what they're currently earning. So far for this year, they've announced dividends at their normal dividend rate through the month of June. But when considering this continuous fall in dividend coverage, it's making me nervous about the safety of this dividend. The share price of this BDC has fallen by over 52% in the last 3.5 years, which indicates the whole market is skeptical about its future. So unless things improve soon, I'd be cautious about investing in HRZN. Another stock that's been reporting falling earnings, although not as severe as Horizon Technology, is Gladstone Investment, ticker GAIN. This is one of two BDCs that are owned by Gladstone, with the other being Gladstone Capital, ticker GLAD. The one we're going to look at is GAIN. The main difference that exists between the two is that Gladstone Investment acquires an ownership stake in the company, whereas the other BDC simply provides financing just like any other BDC. According to their website, they acquire mature, lower middle market companies with EBITDAs between $4 million and $15 million and that also have attractive fundamentals and strong management teams. For a long time, this stock has had a very high dividend payout ratio. In Q2, they had a payout ratio right at 100%. In the quarter before that, they also had a payout ratio of 100%. In their most recent quarter, which was released 2 months ago, their payout ratio is now 104%. So it's been an ongoing trend where this BDC has had razor-thin margins. Another cause for concern are their very high non-accruals. This is the number of investments that they have that aren't performing up to financial expectations. In other words, they aren't able to pay Gladstone Investment all of the interest that's owed to them. High non-accruals have been a problem for this company for a long time. As of their last reporting, their non-accruals represent 7% of their portfolio at fair value. To put that into perspective, Ares Capital currently has a non-accrual rate of just 0.9%, 7 times lower than Gladstone Investment. The BDC average is roughly 3.1% according to Ares Capital, so GAIN is likely one of the worst in this sector. The dividend history for GAIN, just like HRZN, can be misleading. If we look at their distributions over the past few years, you'll see these giant special dividends that are occasionally paid. You're likely tempted to believe that they're actually doing pretty well because they can pay all of these supplemental dividends. But all of these special dividends are the result of buyouts, which has to do with their acquisition strategy. When Gladstone Investment acquires a company and then later exits the company for a profit, they then pass that one-time gain to shareholders. So although you might look at this and think that they have to be doing pretty well, these special dividends have no impact or influence on their regular monthly distribution. So when considering all of these things, I'm just not persuaded to consider owning this stock. Plus, believe it or not, GAIN is also one of the lowest yielding BDCs in the sector. It currently yields less than 7%. So even though it does pay monthly and it offers better NAV growth and they have been making a lot more deals recently, I just don't think the risk is worth it. Another holding we'll look at is Oxford Lane Capital, ticker OXLC. According to their website, they're a publicly traded registered closed-end management investment company. So in other words, what we're looking at here is a closed-end fund. It currently seeks to achieve its investment objective of maximizing risk-adjusted total returns by investing in debt and equity tranches of CLO vehicles. CLO investments may also include warehouse facilities, which are financing structures intended to aggregate loans that may be used to form the basis of a CLO vehicle. This fund has been publicly traded since 2011, and today they offer an outrageous 24.5% dividend yield. If you're not too familiar, Oxford Lane is a CLO fund. There's only a few of these funds that exist that hold CLOs, including XAI Octagon Floating Rate and Alternative Income Trust, Eagle Point Credit Company, and now Ellington Credit Company, which just became a CLO fund about a month ago. These investments pay large, yet sometimes unpredictable dividends. Most suffer from long-term NAV erosion, but some are better choices than others in this field. If we look at OXLC's dividend history over the past 3 years, you'll actually notice that they've been growing their dividends, which looks really good. But after looking at their recent metrics, things don't appear to be looking that optimistic. This financial highlights slide on their website shows the downward trend that's been going on for the past few quarters. You can see core net investment income can just jump from one quarter to the next, but it's been slowly going down as time goes on. You'll see all the way to the right that they actually had a very comfortable payout ratio in Q3 of last year. But they've not only been reporting declining income, but they also grew their dividend, and pretty aggressively in my opinion. As of their most recent quarter, they have a dividend payout ratio of 96.4%. Again, just last year it was a comfortable 61.5%, so things are going downhill pretty quickly. I'm kind of surprised that their NAV has actually been pretty stable since last year, despite the falling income. But if we look at their share price performance, it's just been downhill since their launch. If you wanted to make a decent return with this holding, then you'd be forced to reinvest all of your dividends, so it hasn't been an ideal holding for someone who wants to live off distributions. But that's going to conclude our look at some dividend-paying investments that are potentially facing dividend cuts. Go ahead and let me know your thoughts in the comments. Do you hold any of these positions? Do you think I'm wrong on anything? Or do you think it's best to stay away from these holdings? Feel free to share your insights, but with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.